So I'm here with Matt Kremers today of Envision Capital in Minnetonka, and we are going to talk about all things construction financing. So we're going to start really broad, Matt. Thanks for being here, Matt.
Thanks for having me.
So let's talk really high level. We want to break down a rather complex topic of financing and talk about generally speaking, what are the options? I'm coming to you, I want to do a construction project.
Sure.
What are all of my options?
Yeah, so the most common one would be a construction loan, like a full-fledged construction loan for your project. That one, I would say, is 80% of the time what happens. The other options would be depending on equity position in your house. Some people have enough equity if they're doing like a $250,000 project, for example, where they could cash out on their current home and then not have to take on the cost of a construction loan and then manage that cash to do their project.
Okay, you've lost me already. No, I'm kidding. Okay, so option one is construction loan.
Construction, yep.
Option two, it sounded like, was a cash out refinance.
Correct.
Okay, what other options are there?
The other more uncommon option is there's future value home equity lines of credit, or just home equity lines of credit that you could take out against your house. Again, that's an equity. You have to have quite a bit of equity to do that. The future value line of credit is really restrictive. It has to be at 80% of whatever the future value is. So that one commonly works for real small projects. They also typically cap those loan amounts at around $250,000.
Okay.
And the other issue is if you do a second mortgage, you're taking higher terms, like worse terms and rate for those types of mortgages. So a lot of times, once it goes over $250,000, you want it all included into one loan in a first lien position. So yeah, those.
You're affirming that this is a complex topic.
Yeah. The point of a loan officer then is to, real quickly we can identify your future value, your current value, what you owe on your home, and then help navigate through a lot of those products so you don't have to understand all of them.
Right.
We're supposed to come to you with, here's your best option, and then here's why.
Okay. So when you start the conversation, you typically are looking at what is the project that's being done and what is the value of the house going to be once that project is completed.
Yep.
Is that correct? So
Correct.
That's future value is what we're talking about there.
Yep. The things that we'll identify, there's two parts to getting approved. There's obviously the credit part, which is, completing an application and making sure you qualify. But the bigger part is the project. So in an initial conversation with people, a lot of times I'm asking them about the project, what they're doing, what if it's a remodel, for example, of a current home, what they owe on their current home, because that's important in that equity position. And then talking about if they've identified any type of future value. I know that one's a lot harder for people to understand, but sometimes people have an opinion, or we have projects that we're doing in that area where we can give them, some type of idea of value. It'll have to be appraised, obviously, independently, but that helps kind of identify the initial project for people. So in the instance of somebody owes $500,000 on their house and they want to do $500,000 in renovation, so you have $1 million there in total. Ideally, your house would appraise then at $1,250,000, so that you're at 80% loan to value, and you can finance the whole thing all together in one construction loan. But the big thing is, yes, what they're doing for their project, how much they think it's going to cost as well to do, and a lot of times they don't know that exact number, and then what they owe on their home. And then from there, we put together a spreadsheet and kind of lay out, options for them. And kind of work through as the numbers are adjusting for build costs as they're going up, which they typically do, what that means and cash out of their pocket versus what we can finance.
First things first is knowing, what does the project look like and what is the future value of the house going to be? Because the future value is going to determine what you can borrow against. Is that right?
Correct. Yep. So the issue with future value is we don't actually get the exact future value until you have your full plans and specs on your house and then the bid from the builder. We take those items and then go and get the property appraised at that point, and that's where you'll have it. We'll do estimates to start off, just to work, through numbers and try to get an understanding.
Essentially using comps.
Yeah. Using comps or using other projects, or sometimes people have real estate agents involved that are helping them, consulting with them during it. That'll give us an idea of value.
So we establish what future value is, and we do that based off of high level what other projects have been done in the area.
Yep.
Secondly, a person has plans for a project and specs in terms of we're putting tile here, we're doing countertops here.
The selections don't have to be perfect on that, and it does depend on the type of loan you do, how accurate that bid needs to be. There are certain loans that you can have allowances on everything, and it doesn't have to be picked out. There's other loans that are a little more stringent with that, which we commonly don't do, because they don't work well throughout the process. That would need a lot of that detail already picked out.
Okay.
So they're less flexible.
Okay. So you've gathered, essentially, everything so you have a good understanding of the project and what's going to happen.
Yep.
And then you still will go through an appraisal process.
Correct.
Okay. So how does the appraiser approach valuing a property when they don't really, there's nothing to really walk through or touch and see?
Yeah, they do future value. So they have plans and specs, so they can see what that value or what the house is going to look like. They have an idea kind of the scope of work, for finishes. And then they'll look at comparables. If it's a 2-story, they'll look at comparables that are in a similar square footage. And they look at above ground separately from below ground. So like on a 2-story, they'll look at how big the footprint of the house is, and then how much above ground square footage is, and then look at comparables that have sold for new construction around the area and use those as their comparables to drive value.
Okay. So the appraiser comes back then with here's what we believe the project will be worth when it's all done.
Yep.
And now if I'm the client coming to you, now what is my next steps? You're going to present me with options.
So the options usually are already laid out. We would already have a specific loan disclosed and everything to a borrower before we order appraisal. Once the appraisal comes back, that's where if value is low or high, then we adjust that loan amount and talk through numbers again, just to make sure. So if appraisal's kind of like, hey, it came in great, nothing needed, or maybe we need to adjust because it came in low, which happens at times, and then a lot of times we'll adjust project to help out with that.
So we adjust the scope of the project to create more room in the budget, or get the value to appraise higher, which is kind of a series of pushing and pulling levers, maybe we need one more bedroom, or maybe we need to reconfigure this space a little bit differently.
Cut out a pool. Just things that, don't help with the appraisal. So there are certain things that sometimes, are wishes that maybe don't work out in the financing part of it, that then
the golf simulator.
The golf sim. The $100,000 golf sim. So in that situation, it's like you may have to pay cash for that. Or do it later on. Okay.
So so when you talked about the different options of construction loan versus home equity line versus cash out refinance, cost-wise, what are advantages and disadvantages?
Yeah. So the full construction loan, if you had, from a cost perspective, if I had to order them, it would be construction loan is the most expensive, cash out refinance as the medium cost, and then a home equity line of credit as the lower cost. The lower cost one would be more of a variable rate situation, so you're not getting as good of terms because it's a second mortgage. Granted, the costs are low, also limited to a loan to value, so you're going to have a lot lower loan amounts and a lot more restrictions with something like that.
So what you're saying is with a home equity line of credit, you don't have a fixed rate. So your interest rate can fluctuate as long as you have that home equity line. So if the prime rate goes up, your rate goes up too.
Yeah, so if you have a real large project on a line of credit, maybe that's not the best.
Okay.
You know, and it depends on your terms for your first mortgage too. Maybe you have $1 million first mortgage that's at 2.75%, so you don't want to touch that regardless of what that line of credit does.
Okay.
But if you have a $400,000 mortgage and a $250,000 line of credit that's fluctuating, it's probably better to have that all in one.
Okay. Okay. So the advantage of home equity line is low closing costs, very minimal. Like, is it?
For the future value ones, they're around 25. It depends on loan size, but around $2,500.
Okay. So 2,500.
Yep.
Or plus or minus.
Right.
So that's the pro. It's a revolving line of credit, so you can pay it down and then borrow back against it. It's kind of like a big fat credit card.
Right. Exactly. Okay. Tied to your house.
That you can lose your house.
Right.
Details.
Right.
Okay, so then going up in cost to the borrower is cash out refinance. So pros, cons.
So the cash out refinance, if you can accomplish it, would be the easiest method because you aren't dealing with draw schedules or draws or any of that. You're paying the builder cash from your house to do the construction. The downside to that, you know, it's similar to refinancing, so the cost would be similar to if you just refinance. Okay. The downside to that would be, again, restrictive loan to value. Commonly, you can do a cash out refinance on your first mortgage up to 80% of your home's value. So a lot of times there's not enough equity for people to complete a bigger project because of that. Okay. And they're not going to go off your future value, they're going to go off your current home value. Yep.
So, okay, let's break that down a little bit. When you talk about loan to value, we're talking about, let's say for easy numbers, you know, like the home is worth $500,000.
Yep.
And you can borrow on a cash out refinance up to 80% of that value.
Correct.
Less what you already owe on the homes, correct? Yep. So, well, 80%.
Yep.
Period.
Correct. 80% altogether.
Okay, so do the math for me on like a $500,000 property.
Yeah, so $500,000.
And I owe $200 on my mortgage.
$200. Yep. So that would get you, what is it? Another $200,000.
So that would be 80% of that would be $400,000.
Correct. Yep.
But I already owe $200. So the gap left in there is another $200 that I could pull out during a refinance.
Yep. Exactly.
Now, one thing to keep in mind with that is that now my loan amount is 80% or $400,000. So my monthly payment goes up with that.
It's going up. Yep.
So that's another thing to keep in mind. So home equity line, you're not touching your actual loan amount. I mean,
you're the home equity line, you're adding another loan. So you're not touching your regular first mortgage loan amount, but you are adding another secondary payment. So it'd be the nice thing about the cash out would be that you can have it all in one loan. So you're going to get it all in one fixed rate, low terms. The home equity line of credit has cheaper costs and can go off future value. The regular cash out refinance would be based on your current value, not all the improvements you're going to do to your home.
Okay.
So that's usually the big restriction on that one.
And also keeping in mind your interest rate, you're going to be refinancing your interest rate. So if you're at a really low interest rate, it may go up or, you know, vice versa. But
correct. Yep. And if you're at a super low interest rate, like in our example of $200,000, say you're at 275, maybe a line of credit makes sense for $200,000 instead of doing a full cash out refinance. You can just do a regular home equity line of credit, not the first option, the future value line of credit. Okay. So that would be an option as well. You know, when your loan balance is half and half, it probably makes sense to put it all with where rates are at in a fixed loan. But again, that's stuff that will help, you know, direct people into the right product with.
Okay. So then going up even further is the most commonly used product, you would say?
Yep.
Do you call them products?
Yeah,
In the
loan
world.
products. Yeah.
That was news to me when you shop products.
Right. Yeah.
So
Loan options, loan products.
Okay. So it'd be cool if like a borrower came in and said, "I want to shop your products."
Yeah, it'd be amazing.
Okay. So, someone comes in and they're looking for a robust like construction loan. And
Yeah.
what is a construction loan?
So a construction loan will take down your first mortgage and go in first lien position. So the first thing you're doing with a construction loan is paying off whatever you owe on the house. And it's similar to a home equity line of credit where it's an interest-only payment during time of construction, but it's going to be for whatever your first mortgage that you owe is, along with the cost for construction. And so in this case of a $1 million total construction loan, if you owe $300,000 on your house, you're going to start with the interest-only payment of $300,000, plus usually there's an initial draw for construction. So you'll start interest-only payments at like $500,000, and then as your construction is going on, your interest-only payment will increase. So you'll start at roughly $1,700 a month, and then maybe go to like $3,500 a month in interest-only payments in that scenario during construction. Okay. It is different from a line of credit where the rate doesn't adjust. Mm-hmm. It's just fixed, and you have a 1-year term to do construction. If it goes longer, we can get extensions for those, but yeah, typically it's like a line of credit.
Okay, so a construction loan is a new loan. It's a new loan on your house. Yep. So whatever you had before, it doesn't matter. It's just all going away.
It's all gone.
Okay,
yep.
So, and it's based on the project when it's all completed.
Correct.
So yep. Future value.
Yep, plans and specs are done. You've committed to a design and all of that with the builder. We've gotten the future value, and then we set your loan amount based off of that.
Okay, and is that also 80% that you can borrow?
You can go to 90. The short answer is you can go to 90. Okay. The longer answer is they want them at 80% loan to value, but what we do is it's called a builder carry. So we make sure that at the end, at completion, that the builder will not get the other 10% in equity. So like if it's $1 million project, we'll do a loan amount of $900,000, that'll be 90% loan to value, but 100,000 of that to get you 80% loan to value will be held until we close on the end loan for construction. So 90 is probably what everybody needs to know out of that, but they will hear that sometimes construction loans are prohibited to 80% loan to value.
Future value is established. They're borrowing 80 to 90% of that. So what happens with the funds? So the funds have been established. Who's getting what?
So in the initial, like in the example of the $1 million, $300,000 was going to your bank to pay off your first mortgage. $200,000 of your initial draw would go to the builder to start your project. The rest of the money is just sitting at the bank being ready to be drawn. Okay. So as your construction goes on, the next step would be there for them to do another draw. The draw request would go to title company. Title company makes sure that everybody's getting paid, all the mechanics liens are being cleared, and then they'll release funds for the draw. So, and then that goes to the builder. But you as a owner sign off on the draws as well.
Okay, and when you talk about draws, we're saying that the builder has a series of bills that have built up to be paid, and they're requesting payment from the title company saying like, okay, here's all the bills we need to get paid off. And the title company actually pays those out, not the builder.
Correct.
And then the title company is collecting all the lien waivers for all those payments so that one of the subcontractors can't come back, put a lien on your property and claim that they were never paid.
Correct.
So there's a lot going on behind the scenes with the title company to protect the borrower.
Yeah, absolutely.
So let's say, we closed on the construction loan to begin the project. And now as we've been going, we've been making interest-only payments, which have been growing because we're drawing more and more funds as we're getting further down the road. So, okay, now we've completed our project, and how does this whole process come to
And
an end.
yes, so at that point, it kind of depends because there's a one-time close construction loan and then there's a two-part construction loan, and it'll depend on the type of bid you did, if it had allowances and everything else, your loan to value, which one that will select for you. If you do the one-time close, you get converted into your 30-year fixed or ARM or whatever product we picked at the beginning for you. So your loan, everything's done. They make sure the contractors are all paid out, and then they close on that end loan, and you're set.
Is there a closing that happens, or?
There is, but it's very informal. It's at your house.
Oh, okay.
So your house is done. We send a notary to your house to sign, any modification documents if it's a one-time close, or if it's the two-part closing, then we have your formal loan closing. At the
Okay.
end.
So with a one-time closing, you pay closing costs one time.
You pay closing costs one time, but they're more expensive than just the construction loan because
Okay.
you're kind of closing on both loans at once.
Okay.
Well, the one-time close would save you from mortgage registration tax and some additional title fees. So a lot of times those save, $3,000 or something. It depends on loan amount, but we'll just say like $3,000 in costs. The rates aren't as competitive as like a market rate would be. So the offset would be, if we do the end loan, you can go to market with that, and we can go to all investors with it again.
Oh, I see. So whatever rate you got up front on the one-time close is traditionally going to be higher than what
current
market value
rate is.
rates
Yeah,
are.
about a quarter point higher.
Okay, but you're kind
Just
of
because they
stuck
have
with
to
that.
lock you for so long during
Okay.
construction.
And you said they're typically a 1-year term on those loans?
1-year term.
To get construction done and get the whole
Yep.
thing closed out.
Yep, and we know with current environment that delays happen, so you can get extensions relatively easy. And you do have to pay for them, but it's like $300 to $400. It's nothing crazy. You don't have to like start the whole loan process over.
Okay. And so then with a 2-time close, you're, doing the construction loan, the interest-only payments at a certain rate or a revolving rate?
At a fixed rate.
So a little higher than what prime rates are.
Yep, and they want to do that so that you don't keep your construction loan.
Oh,
If you didn't take the regular mortgage out. So usually in the two-part close, about 90 days or 60 days before we think the project's going to be done, we start the end loan approval process so that the day that the project's done, they can just close on their end loan.
And is that kind of like going through the pre-approval process all over again?
No. I mean, you'll have to submit updated pay stubs, maybe tax returns depending on the time of year, and some updated asset statements, but you don't have to reapply or do anything.
Are you subject to what current rates are, or did you lock that rate?
It depends, but commonly we don't lock the rates until 60 to 90 days out from completion if it's the two close part.
Okay.
Only because, in my opinion, a lot of the extended lock stuff is pretty expensive.
Oh, okay. Okay. So then at the end of the 2-time close, it's an actual closing. You're paying closing costs again.
Yep.
Okay.
And that's where you'll have a little bit of duplicate fees and title and mortgage registration tax. So it's usually about, again, like $3,000 in difference.
Okay. But the overall advantage of the more robust construction loan as opposed to the cash out refinance or a home equity line would be?
The biggest advantage is it'll fund your whole project. So commonly anything that's over $250,000, you end up having to do a full-fledged construction loan so that you can use that future value so that you can pay everything off and then have it all in one mortgage.
Okay.
So that one's.
So you get to finance your whole project in one payment at the end.
Yep.
Versus kind of like, a home equity line, which is kind of this revolving, unfixed, like pay it off like more quickly probably, because you don't really want that like.
Well, you hope to pay it off quickly. Yeah.
So you would want to kind of have a strategy for getting that paid off.
Correct.
Quickly.
Yes.
Okay.
Yep.
And then the cash out refinance is kind of an advantage for people who have significant equity in their home already.
Yep.
Okay. And those looking to do a project over $250,000.
A big project.
A big project, going to take some time want to just get into one loan at the end of
Right.
it all. It's
Yep.
kind of a construction loan.
It's a construction loan then.
Okay.
Yep. And that's why that's the most common. I mean, it's usually bigger renovations that are happening. So
And is this process the same if someone was doing new construction?
it's similar, yeah. The only, instead of paying off a first mortgage, we're going to use that construction loan to help you buy the property instead. So you're going to start off with a balance because you purchased a property. So yeah, in the $1 million example, somebody buys a lot for $300 and they do $700 in construction. We'll need 10% down or $100,000 from them, and then we'll use the construction loan to immediately purchase the $300,000 lot, and then again, probably an initial draw of $200,000. So you're starting with those interest-only payments.
One question, generally speaking, with the construction loan, is there a minimum percent down for borrowers?
That's 10%
Oh,
for
10%.
the construction loan.
Okay,
Yep.
so you have to have 10%.
Have to have 10%.
So let's say they're in the project and they're making these selections. We already know what the loan amount was to begin with, but now we're starting to have overages.
Yep.
Like what do we do?
So typically up front, we know you have a construction contract, you have your bid, we know what everything's going to look like, it's signed off on, and that's it. But people make changes. So when people make changes, there's times where we can adjust the loan amount if there's a decent loan to value. Otherwise, it's cash. Like you have to come up and pay for that stuff.
Okay.
So
there's no fairy.
No, there's no new money tree that starts growing. There are times though we've had to like redo a construction loan, or we've had to add a second mortgage onto the back of it to help fund those things, knowing that we can close at the end with the right loan amount for them.
Okay.
And pay it all off.
Okay.
So yeah, there are adjustments that happen. Typically, you want to have all that planning done up front, so you're not caught with those surprises.
And that is really the responsibility of the borrower,
the borrower's relationship with the builder, and making sure they trust each other and understand the contract they're in. Another pitfall would be starting your project early before we have closed on the loan. So, and that's, in a rush situation, or people like, I own the house, so I'm gonna do whatever I want. Well, if you start cutting down trees and all of that stuff, make sure you talk to your lender first, because title, it's more from a title standpoint. They need to make sure that there's no liens on that property. So if they go out, they do a site inspection before every construction loan. If they go out and see that some work has been done, they need to know that that's paid for, provide invoices, and clear lien waivers for anything, and it can hold things up.
Okay.
And we've done where people have already started a project and then like, over our heads, we need a loan. But you have to do an early start, is what it's called. So it's like a whole nother level of approval with title company, which takes a little bit of time. So don't start until you talk to your loan officer.
Okay. I didn't know that.
Yeah.
And kind of on that, I was wondering what's the typical lead time? What can people expect from the start of the process to completion of approval?
Yeah, for the approval, that usually takes, from a credit side, that takes a day, 2 days for us to put together options and get that part going. The big thing is, the bidding process and getting the plans and everything, that can take 30 days, that can take 60 days. It just kind of depends. I mean, that timeline is drug out a little bit in the last couple months. Once we have plans and specs in the bid, we can start the loan process, but we can't start it until then. So you're looking at about a month from once you have your plans and specs to actually close on the loan. And then from there, usually title needs about a week to clear everything so that you can start your project.
Okay. Which that poses some interesting issues for us as real estate agents when we're looking to buy and renovate right away, because in a competitive market, trying to get a 60-day close is impossible. So what do we do in that case?
You hope you get plans quick, and that's usually in the case of a purchase. Yes, it's a lot of times 60 days. get out there and get the property inspected right away and hope that you can get a contractor out there with you to look at it and start that bidding process. We can shorten up the timeline if we need to a little bit on our end, but that's usually, just in a disclosure world, the fastest we can usually close is 2 weeks. Okay. So we need a minimum of that, and that's, in a 60-day process, you probably need your plans and specs in 30 to 40 days.
Which is one advantage of working with Fox Realty, right? Yeah. Because we have all those people on staff.
Correct, that show up at the inspection,
Yep.
that know the bidding process, that get us exactly what we need.
Right. It helps that we share office space too.
Right.
And you can just pass that across.
Yep.
across. I mean, it really does. I don't know how else
it
you
helps.
could get that done.
Yeah.
We often try to make it look really pretty and organized and detailed for our clients, but there's a lot of moving parts going on between construction, financing, real estate. I mean, all of
and it's a lot to navigate.
Yeah.
We try to make it less for, the clients not having to be, it's stressful already buying a house. So I try to guard them a little bit from the chaos that is going on.
No chaos here. No, it is. It's chaotic. It's kind of crazy to even try to make it all work, but we do.
It's always worth it in the end. And obviously with inventory being what it is now, if you want to have the home, in a specific way, it's the only way to do it right now.
So in that case, we're looking, that's a 2-time close product that we're doing.
Absolutely,
in that case.
2-time close for that, because the one close, you'll miss closing every time.
Yeah.
So a 2-time construction close would mean that we're starting with a construction loan, which is similar to a home equity line of credit, and then ending with an end loan, which would be your 30-year fixed or ARM or whatever loan product you choose. The beginning of it would be interest-only payments, and then the end would go into a full amortized payment. And so, the difference between a 2-time and a 1-time construction loan closing is that there's duplicate costs from a 2-time closing. You're paying mortgage registration tax, and you're paying a little bit of additional title fees to do so.
So I think if anything came out of this conversation, it's that it's super critical to have an experienced lender that you're working with if you want to consider construction or really any financing whatsoever. And it seems like, when would you say in the process, how soon should you be getting your lender on board if you think construction might be in your future?
Yeah, if you think construction's in your future, I would definitely recommend reaching out to the lender as either the second person, maybe even the first person, when working through and trying to figure out your financing options. It's always good to have an idea of what your build costs would be, so maybe consult with a builder to see if your project's even feasible. But then the number thing, the boring stuff, needs to start next to make sure that we can accomplish what you want to.
Right, unless you have an unlimited source of funds, really the financing is the most important piece. I mean, it's going to tell. It's really no different than in real estate when we're looking. When someone approaches us, we want to buy a house. It's well, the lender provides us that roadmap. We don't. I can show you houses till I'm blue in the face, but I can't do anything until the lender says I can. Yeah. So it really is the same process either way, and you're more empowered. You're more educated. You're better leveraged.
It definitely helps just in the budgeting. You're going to have to set a budget, and you're going to have to start trimming out or adding what you want to do to the property. And without understanding what that means from a cash position or payment position, it's very hard to make those decisions.
Yeah. And I think of if you sit down with an architect and you start drawing out a project and accruing costs for plans, and you ultimately get to a project that you could never afford in the first place, you have to pay more costs to go back, redraw the project.
And they're not cheap.
No, yeah. So it really is just in your best interest. The lender is working for you.
Yep.
And
it doesn't matter if you apply early versus late. Most applications are good for 120 days.
Okay.
So you have plenty of time there.
Okay. This has been so great, Matt.
Yeah, thank you.
Thank you
It was
so
fun.
much.
Hopefully I answered questions.
You did, lots of them. Then we tried to decode what they meant.
Right, right, I know.